Welcome to the channel, everyone. Today, we're talking about investing, and more specifically, my 10 best tips for investment success. Now look, I get it. Investing can seem like this big, scary thing, especially when you're just starting out. You hear all these complicated terms, you see the market going up and down like crazy, and it's easy to feel overwhelmed. But here's the thing. Investing is one of the most powerful tools you have for building wealth over the long term. It doesn't have to be complicated, and you don't need to be a Wall Street genius to be successful. These tips will provide you with a solid foundation for making smart investment choices, regardless of your experience level. Whether you're just starting out with a few $100s or you're already sitting on a sizable portfolio, these principles remain the same. So, tip number 1, and this is a big one, is to diversify your portfolio. Don't put all your eggs in one basket. We've all heard that one before, right? But seriously, it's crucial. Imagine you're putting all your money into just one stock. What happens if that company goes belly up? You're out of luck. But if you spread your investments across different asset classes, stocks, bonds, real estate, you name it, you're protecting yourself from major losses. Think of it like this. You're building yourself a safety net. If one investment takes a hit, the others can help cushion the blow. Diversification is all about managing risk and ensuring that your portfolio is resilient enough to weather any market storms. And trust me, there will be storms. Now, before you even think about what to invest in, you need to understand your risk tolerance. This basically means figuring out how much risk you're comfortable taking with your money. Are you someone who freaks out when your investments drop a few percentage points? Or are you more the ride the waves type? There's no right or wrong answer here. It's all about what you're personally comfortable with. If you're younger and have a longer time horizon, you can afford to take on more risk. But if you're closer to retirement, you might want to play it a bit safer. The key is to find investments that align with your risk profile. Alright, tip number 3, and this should go without saying, but I'm going to say it anyway. Do your research. Don't just blindly invest in something because your friend from high school told you it was a sure thing. Take the time to understand what you're investing in. Read up on the company, the industry, the market trends. Look, there's a ton of information available online, much of it for free. Use it. Read books, watch documentaries, listen to podcasts. The more knowledge you have, the better equipped you'll be to make informed investment decisions. Remember, knowledge is power, especially when it comes to your money. Chapter 4. Set clear financial goals. This one's huge. You need to have clear financial goals. What are you investing for? Retirement? A down payment on a house? That dream trip around the world? Having specific goals in mind will not only keep you motivated but also help you determine the best investment strategy. For example, if you're saving for retirement, which is decades away, you might choose more aggressive investments. But if you're saving for a down payment on a house in a few years, you'll probably want to go with something more conservative. The point is, your investment strategy should always be aligned with your goals and your timeline. Chapter 5. Keep an eye on fees. This is something a lot of people overlook, but it's so important. Fees can eat into your returns like crazy. We're talking about things like expense ratios on mutual funds, trading commissions, account maintenance fees. They all add up. Now, some fees are unavoidable, and that's okay. But you want to be aware of what you're paying and make sure you're getting good value for your money. Don't be afraid to shop around and compare fees from different brokers or investment platforms. Remember, even a small difference in fees can make a big difference in your returns over the long run. Chapter 6. Stay informed. The world of investing is constantly changing, so it's crucial to stay informed about what's going on. Now, I'm not saying you need to be glued to CNBC all day, but it's a good idea to keep up with market trends, economic news, and any major events that could impact your investments. There are tons of great resources out there. Websites, podcasts, financial news apps that make it easy to stay in the loop. The key is to find sources you trust and that provide accurate and unbiased information. This is probably the hardest one, but trust me, it's worth it. Investing is a marathon, not a sprint. Don't expect to get rich quick. In fact, forget about getting rich quick altogether. Real wealth is built over time, through consistent investing and patience. There will be ups and downs in the market, that's inevitable. But if you've done your research, you've diversified your portfolio, and you're invested in solid companies or assets. There's no need to panic when the market takes a dip. In fact, market downturns can be great buying opportunities. Look, I get it. It's your hard-earned money on the line, and it's easy to let your emotions get the best of you, especially when the market is being unpredictable. But here's the thing. Emotional decisions are rarely good decisions, especially when it comes to investing. If you see your investments tanking and you panic sell, you could miss out on potential gains when the market recovers. On the flip side, if you get caught up in the hype and buy into a stock that's skyrocketing without doing your research, you could end up losing a lot of money. Remember, fear and greed are your worst enemies in investing. Okay, so you've diversified your portfolio, you've set your financial goals, you're staying informed, great. But here's the thing, your work isn't done. Over time, your investments will perform differently, and your portfolio might become unbalanced. For example, let's say you started with a 60-40 split between stocks and bonds. But after a few years of a bull market, your stocks have grown significantly, and now your portfolio is more like 80-20. This means you're now taking on more risk than you initially intended. Rebalancing is all about bringing your portfolio back into alignment with your original risk tolerance and investment goals. And finally, tip number 10, don't be afraid to seek professional advice. Look, I know financial advisors can seem intimidating, and you might be thinking, I can handle my own finances. But the truth is, even experienced investors can benefit from the guidance of a qualified financial advisor. A good advisor can help you create a personalized financial plan, choose investments that are right for you, and navigate the complexities of the market. Think of it like this. You wouldn't perform surgery on yourself, would you? So why would you trust your financial well-being to just anyone? Thanks for watching. Look, I know that was a lot of information, but I hope you found it helpful. Investing doesn't have to be scary. Just remember these 10 tips, and you'll be well on your way to building a brighter financial future. If you found these guidelines helpful, don't forget to like, subscribe, and hit the notification bell for more investment tips and financial advice. And remember, the most important investment you can make is in yourself. Keep learning, keep growing, and keep crushing it. Happy investing!